This also goes for gold, though. Even in this system, gold has appreciated from $35 an ounce 50 odd years ago to $2,500 an ounce, even within this system. A London bar, 400 ounce London bar, in 1971, you could buy one of those for 14,000 US dollars. It now takes about 1.1 million US dollars. The bar hasn't changed. Bar's the same bar. Okay. So that's how the gold, and then eventually the silver too, protects your purchasing power. And that's why everybody has to have some. And, if the banks are going to beat back the price and give you a gift that China's happy to take, that Russia's happy to take, that India's happy to take, you should be happy to take it as well. Don't be sore, buy more.
Market analyst Craig Hemke advises investors to emulate the strategic approach of major sovereign buyers like China, Russia, and India in viewing price corrections as accumulation opportunities. This perspective gains particular relevance as central bank gold purchases maintain momentum, providing a counterbalance to potential downward pressure from dollar strength. The precious metals market is experiencing a significant evolution in Asian consumer demand, particularly in China and India. The proliferation of local gold mutual funds, ETFs, and supportive regulatory frameworks have enhanced retail participation in these key markets, adding a new dimension to traditional physical demand patterns. Goldman Sachs projects continued strength in the gold market, forecasting prices could surpass $3,000 per ounce by late 2025. This outlook is supported by increasing central bank acquisitions, particularly among nations concerned about potential U.S. sanctions. Poland and Hungary's recent resumption of gold purchasing programs exemplifies this trend, reflecting a growing recognition of gold's role as a strategic asset in an uncertain geopolitical environment. Looking ahead, several factors appear positioned to support prices for precious metals. The anticipated monetary easing cycle and potential fiscal policies under a new U.S. administration could increase deficit spending and inflation risks. These developments would likely reduce the opportunity cost of gold relative to U.S. dollars and Treasury securities. According to Hemke's analysis, the silver market presents a particularly compelling supply-demand dynamic. A persistent annual supply deficit of 200 million ounces over 4 years and limited availability of above-ground silver due to its incorporation in consumer goods creates significant market pressure. This situation is further intensified by accelerating demand from electric vehicle manufacturing, renewable energy infrastructure, and broader electrification initiatives. The global transition toward renewable energy technologies drives substantial silver demand, contributing to a projected supply deficit of 182 million ounces in 2024. This structural imbalance and expanding industrial applications suggest sustained support for silver prices as industrial consumption grows alongside traditional investment demand. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
And you have these massive short positions by the commercials and the swap dealing banks, and then it's always up against the speculators. It always is. The banks are always short and the speculators are always long. You won't find that anyplace else. And all of this is why, again, we could go on and on about the CFTC and everything that I've learned over the last 15 years in dealing with them and the people that I know and their dealings with them. At the end of the day, like the debt, it's a pricing scheme that is unsustainable. The amount of silver being used now, this is going to be the 4th year in a row of at least a 200 million ounce supply deficit. Now, how many ounces are already above ground? If you count grandma's candlesticks, and platters and tea set, I don't know. 2 billion ounces, 3 billion ounces, if you think of all that stuff. So maybe we got a ways to go. But however, with the electric trade, the EVs and electrification and green and all this kind of stuff, the demand for silver and copper as well in the years to come is far going to exceed supply. And eventually the system, like the debt-based monetary system, just kind of collapses on itself. And it's almost the analogy I like to use, and again, here I have too much coffee, and it's still early in the morning where I am and afternoon where you are, is like, and this is timely because everybody's watching It's a Wonderful Life this time of year, and the system for pricing silver and gold, for that matter, is a fractional reserve system, not unlike the Bailey Brothers building and loan. Your money's at Ed's house. And, that scene where George is supposed to be going on his honeymoon, but Uncle Billy gave out all the money and now everybody wants their money. It's like you can't go to your local bank and take out $2 million. They don't have it in the safe. It's, they have reserve requirements. It's a fractional reserve system. The COMEX is a fractional reserve system. And so even as the supply draws down, they keep the system running. But the leverage, the tightening of that leverage, it's getting tighter and tighter against them. Okay. And the leverage is going higher and higher. And so eventually it's going to run out. And that's what makes silver such an intriguing investment, even just from a capital appreciation standpoint, because we don't know how many ounces are free and clear of title. I know I can call up Miles Franklin today and you guys will send me some silver, right? But when it gets to the point where China is demanding 500 million ounces in a year, can they get it? You showed that chart of the London vaults only have 300-400 million ounces in them. Well, okay, what happens when it's gone? What's the price? I don't know. So it's been extraordinarily frustrating to hold it. But even here at $29 or $30 or whatever, I think the capital appreciation long-term is significant. If I might add one last thing, Andy, too. This also goes for gold, though. Even in this system, gold has appreciated from $35 an ounce 50 odd years ago to $2,500 an ounce, even within this system. A London bar, 400 ounce London bar, in 1971, you could buy one of those for 14,000 US dollars. It now takes about 1.1 million US dollars. The bar hasn't changed. Bar's the same bar. Okay. So that's how the gold and then eventually the silver too protects your purchasing power. And that's why everybody has to have some. And, if the banks are going to beat back the price and give you a gift that China's happy to take, that Russia's happy to take, that India's happy to take, you should be happy to take it as well. Don't be sore, buy more.
Market analyst Craig Hemke notes that this movement, involving recasting traditional 400-ounce bars into kilo bars preferred by Asian markets, presents potential challenges to the Western derivative-based pricing mechanisms that rely on steady physical gold availability. World Gold Council executive Xiaokai Fan confirms this market evolution, identifying a definitive shift in the gold market's center of gravity toward Eastern economies. This transition is particularly evident in the rising gold consumption patterns across emerging market economies, with Asian nations leading this trend. Singapore's strategic geographic position positions it advantageously as a potential hub in this evolving market landscape. Singapore is becoming a key player in the global gold market, mainly due to its proximity to major gold-producing regions that account for about 25% of the world's supply. These regions include China, Australia, and Indonesia, which provides Singapore with a strategic advantage. Reuters reports that Asian buyers increasingly acquire gold as a hedge against geopolitical and economic uncertainties. This trend is fueled by a waning confidence in traditional investments, such as real estate and equities, making gold more appealing as a regional strategic asset. Let's get back to the interview.
I always think that then the People's Bank of China has figured out that, that Putin and his cronies have figured it out. At this point, though, they have to sit back and go, wow, they're willing to let me cobble together 2,600 of their American dollars and they'll give me an ounce of gold for that. Okay. We'll take them up on it as long as we can. And so, again, that demand, that shift, all they're doing is on a much larger scale what you and I and most people watching are doing, which is we're taking our dollar reserves, our savings from our hard work, and we're converting some of them into physical metal. Well, that's what these countries are doing at the sovereign level. They're taking their dollar reserves from all their export business and their, economic production, and they're converting them into gold and even now in some cases silver. That demand has played a huge role. I don't think there's any doubt about it, it's particularly in gold this year. Because, again, we're seeing now the third year in a row of record central bank gold demand. And price has rallied this year. What are we this morning? 2,600 or something like that. We started the year closer to 2,000. So we're still up, a significant percentage, 25% year to date, while interest rates in the U.S. have been rising, while the dollar index has been rising. Typically, that's, an environment where gold prices suffer. If you want to compute real interest rates based off of, current conditions and that sort of thing and inflation expectations, gold should have been heading down this year, but instead it's been consistently moving higher, at least until the last 6 weeks or so. So yes, I think the central bank demand is having a major impact. Do they understand? They have to understand what they're doing. I can't imagine. I'll give you one more thing. You talked about the BRICS grain exchange. I remember I mentioned this trading grains with my brother-in-law back in the 80s. And the stories back then were that, that all of a sudden you get this bombing run the Chicago Board of Trade, and all of a sudden wheat futures would collapse over a period of a couple of weeks. And everybody like, what the heck? And then, a couple of weeks after that, here comes some massive Chinese order for American wheat. Again, for over a decade, this kind of steady movement from west to east of physical metal. All the stories we'd hear about taking the 400-ounce bars out of London. And you can actually track this. Remember, I forget his name now. The guy that ran Gold Charts or Us. He retired. He sold it to someone. Well, at least you're not.
You're only 25, so you got a long time to go.
Nick on his Gold Charts or Us site would track. I mean, you could have charts showing the export of gold from the UK, where they don't mine any, right? So it's just coming out of LBMA reserves. And then the import into Switzerland, and then the export out of Switzerland, and then the import into Hong Kong, into China. And again, this has been going on for over a decade. And what's happening is the standard is shifting. They're taking those 400-ounce bars and recasting them into kilo bars, the 49 quality kilo bars. This has been going on, like I said, a long time, and it will continue. It's just a steady drain. And again, people think, well, why? And again, and what is the significance eventually? When this happens, when suddenly there is the West loses that pricing control, the whole pricing scheme that we've been held under, it's a fractional reserve, digital derivative based pricing scheme where the trading of the futures contracts determines the actual physical price. That eventually unravels when there is like I said at the beginning, the banks, those bullion banks have to be able to flow physical metal into that derivative price. Otherwise, it's pointless. I mean, you might as well be trading baseball cards.
The evolving dynamics of the precious metals market highlight a transformative shift in global demand and strategy. Asia's rising influence, marked by increased retail participation and strategic asset accumulation, underscores a fundamental rebalancing in the market's center of gravity. Simultaneously, industrial expansion and geopolitical concerns magnify the enduring appeal of gold and silver as hedges against uncertainty. These factors converge to a future where precious metals remain indispensable in navigating complex financial landscapes. How will the shift in gold's market dynamics toward Asia shape global pricing mechanisms and investment strategies? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.